Welcome to episode 69 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special return guest on to talk with us about what's going on in the energy industry and some of the big picture trends he's looking at, some of the different data that he's collected and the work he's put in, which is definitely something worth a read. It sounds like we'll be getting a little bit of a sneak preview for his Q3 chart deck that should be coming out here soon, but pretty excited to have him back on and we can get into all things energy. But Rob, thanks for coming back.
Yeah, sure thing, Ben. And yeah, just a slight edit there. What I have up here is the Q3 deck. And then in about 2 weeks from this recording, what is it, September 8th, I'll have my 4Q, which is going to include a lot of new stuff that I've been working on, over the summer, been publishing on, updating even an oil price model, and even for the first time really given sort of a long-term oil price forecast, which is pretty new for me with all the necessary disclosures and basically ways of saying how I could screw the forecast up.
Yeah. And for anyone that might be listening on Apple Podcasts or Spotify, you might want to switch over to YouTube or to Substack because there'll be lots of visuals for this conversation. So if you want to switch, now would be a good time. But I figured we could start off with the kind of latest news out of OPEC, maybe get your thoughts there. Some of the bearish sentiment and narrative and all these different things going on, which I think is a little bit overdone, but maybe be interesting to hear your thoughts on OPEC and we see where that takes us.
Yeah, sure thing. So I think like this is a constant battle that I've had in doing this for, I guess you could say coming up on 20 years. And what I mean by doing this is trying to get which way oil prices are going. And I will be the first to admit, and longtime followers know this as well, I'm not a barrel counter. Never will be a barrel counter. And I think that's because of trials and tribulations that I've had, is that I've gone back through the data and tried to regress price versus demand growth, tried to regress it versus supply growth, tried to regress it versus demand minus supply growth. And I just can't get any good statistical correlation between the two. And, even this, knowing this, and then you get into that and you'll get the case of OPEC missing barrels where they make up a number where the missing barrels is because we weren't keeping up, but then 5 years after the fact, here's where they were, right? It's sort of like what you're seeing out of the US jobs data. It's like, jobs are here. No, they weren't. They're down here. And so I've had all these misgivings with counting barrels. On top of that, a lot of the barrels and inventory numbers, like you have no clue about, i.e. emerging markets in China, that I never ever really came to rely upon it. And even with what we're seeing today, the bears are saying it's going to be flooding the market. And, for the most part, the last couple of years, prices have been down and the bears have been right. Like you can't argue with that. But then the people who are more positive in the bulls are saying, look at the inventories numbers and look at the published production numbers. Like they're not going up. Like, does OPEC even have capacity to, reintroduce these barrels back to the market? So what I'm saying is, like, you have this constant, battle back and forth, and the data around what the majority of consensus drives their models around is very opaque. Okay. We rely on really 3 agencies. And so in order to be a barrel counter, I have to be able to convince you that my model of counting barrels is better than everyone else's. And it's just not, it's me sitting in this living room doing this. And so I've always had misgivings on it. Now, and what we're seeing now is they're introducing more barrels, but prices are popping this morning. Like, what are we up? Last I checked, since the announcement. So, it's being taken that consensus was maybe a little bit more bearish, and, they are probably not going to introduce it that fast. But what I rely upon really is what has worked. And this is going to have a updated version again in 2 weeks, be a lot more encompassing. But when you produce a barrel of oil, let me get to the point right away. This model will be updated. I know it says 47 to 59 in that green text in the bottom right, but for the updated model V2.0, the point I'm trying to get at is I think the bottom for oil in the non-OPEC world, or the bottom for oil basically is probably going to be 57 to 63. 57 to 63 bucks. And the upside is 90 to 97 at best. Fair value probably around 78. Okay. Now the thing about fair value is that that's fair value, but you can oscillate widely around it. Okay. So I know those are not the numbers that you're looking at in the chart on the right. But like I said, I have a much more updated model coming up. And the most important cost to the oil industry is, well, let's backtrack. If you want to produce a barrel of oil, there's what I call is like 3 costs to it outside of legal battles, right, Ben? And so
I'll try not to derail. I'll try not to derail the podcast too much. On
that. We longtime followers of Ben know what we're alluding to. But if you're an oil and gas company, let's say you're just starting from scratch, you need to go find the barrel. All right. So there's something called finding and development costs. That's exploration, and then that's committing capital, whether it's an offshore FPSO or drilling rig, or an onshore drilling rig and frac crew, drilling and completion costs. And so after you find that barrel and get it ready for production, you have to start producing. So then there's a cost on top of that, which is production and lifting costs, right? Get that stuff out of the ground. And then your final cost of production is, you got to pay your economic rents, whether that is to the US government or some, Saudi oil sheik, which is less so now because less and less of these companies' production is in the Middle East and what have you. And then after you're with your remaining dollars that's left of your cash costs, you got to go replace that barrel, right? And it goes like that. Find and develop, produce, pay taxes. Find and develop. And so the biggest cost portion is what we call PD, F&D costs. And what I tried to show here on the left is it in the bars on slide 16, is that digging through these annual reports and some other industry resources going back to 1956, you can see that oil and gas PD development costs have a very, very high R squared of about 0.87 versus oil prices. That is a much higher R squared than you'll find with any sort of OECD inventory numbers. So the point I always believe in and try to make, and I have the charts to show it, is that supply will always rise to meet demand if demand's rising, and supply will also fall to meet demand if demand's falling. If you look at a supply, year-over-year supply and year-over-year demand growth for this industry going back to 1866, you'll find that they're the exact same lines. They're literally the same, with a couple differences here and there, but they move in unison. So the theory is that it's the marginal cost. So when industry finds a way to lower the marginal costs, i.e. shales, right? Reduce frac costs, reduce, this whole productivity cycle we've been talking about. With shales, you've had, it's not talked about, but you've had the benefit of eliminating exploration budgets. You don't got to go out and explore for shales. We know where the Permian is. Okay. The beauty of the Permian is it's like a wedding cake. It's just stacked layers of reservoir, less so like the Bakken. So if you eliminate what was a big chunk of the capital in this business, it lowers the cost of the barrel, the incremental costs. On top of that, you have things like industry getting more efficient, producing more with less rigs, less frac crews. And even on top of that, that third cost on the pie component is the U.S. production is historically a lower fiscal tax regime than producing overseas. From 2008 to what I would say about, depending on how you look at it, 2017 to 2020, those were all in deflation, and now they're not. So they're sort of been turning up. But my point is that if you divide this line on the left, oil price divided by the replacement values or PDF and Ds, you get this line on the right with plus and minus one standard deviations around the long-term average. And again, just to say is I updated this. This is just relative development costs. In my latest model, we'll have production and tax costs in there. And the R squared actually goes up to 0.95. So to me, and in my experience, this is a long way to go about it. Understanding the marginal cost and having a gauge of which way those may go has a much higher statistical significance than counting barrels. Okay. Over the long run. Let me caveat that over the long run. Okay. And I'm the Crude Chronicles. I do things in the long run. So my point is that I think the bottom is around 57 to 63. And the peak is around 92, 97 on today's cost structure. But, and I won't get into it. I think that we'll be adding about $30 a barrel over the long run through 2030 to all those ranges to the upside.
Interesting.
Yeah.
As far as like there's been talk about what tariffs and other stuff do to steel costs and the actual cost to drill and complete a well, all these different things. What is going to be the main driver of those cost increase that you're expecting, say, over the next 5 years?
You know, when tariffs were first breaking in or being discussed, like around April, May, and I was looking at it as well as a couple indices on capital costs on upstream and, you know, steel, yada, yada, yada. And I emailed a very popular, one of the biggest operators in the Permian, man, just said, hey, man, getting a lot of questions. Just have you seen an index or that I could maybe regress with F&D costs and possibly yours for D&Cs, drilling and completion, yada, yada, yada. And he said, hey, you can check these resources out. But at the end of the day, it just depends on geology in the rock. That's going to be the biggest driver, period, to F&Ds. And so if you're able to, you know, find good quality rock and have access to it, that's going to be the biggest driver outside of steel and tariffs. Okay. And you saw that in the 70s. You're familiar with this chart, Ben, but maybe, you know, some of your readers are not, is that the point of this is that the well productivity cycle has slowed. And that when that starts to slow, development costs rise. And that's just a matter of geology, right? And if you know the history of this industry, we tend to find the best rock first and drill it first. And then technology adaptations we take into later stages. But there comes a point where the incremental gains get less and less and less. Okay. And so what I show here is in the line is well productivity year over year on a 3-year smooth back to 1934. And that's the orange line. And in the bars is inflation adjusted development cost index. So what you're looking at, if you're watching on YouTube, if not, please head over to that, as Ben said, is that well productivity it can be measured in many ways, but the way I measure it in my belief is the one that matters is output per producing well count. How much is coming out of the hole in the ground? And if more is not coming out on a rate of change basis, it's slowing. Yes, other people measure it by production per foot, but at the end of the day, the stuff has to come out of the producing well. And in the 1940s, you started to see the oil fields that were discovered 2 decades prior in the 1920s boom of the Yates, East Texas, Seminole, and Cushing start to slow, and then development costs begun to rise there. Guess what also rose in the post-World War II boom is that price controls on steel were taken off and wages, right? Sort of maybe there's a parallel to tariffs today, right? But before all that began is the productivity slowed. And then in the 70s, U.S. production peaked in 70, 71. But on top of that, OPEC took away the most productive wells in the world. I did some math, and I've done, my readers know this, like those wells were producing 5,000 to 6,000 barrels a day. Like, I believe if you look in like Saudi Arabia, Aramco used to have annual reports, and I believe it was the mid 50s. They used to tell you the well status by well. It was beauty. Now you can't get that now. It's national secret. But they were producing like 1.1 million barrels a day on only 270 producing wells. That's like amazing. It's astronomical. Guyana actually has much better figures, but different technology. And so it's just the beauty of Guyana right now. But my point, and I digress, is that after well productivity peaked, industry had to move to higher cost regions. And it peaked in 1970, well before 73, 74, and all the oil era embargoes and what have you. And then in 98, productivity peaked yet again. Okay. And so China didn't join the WTO until 01, and China didn't have its diesel demand crisis until 05, 06, but then development costs rose well before that. And the point of this is that, yeah, that's a year-over-year, 3-year smooth, but it peaked in 2019. But the next chart shows, if you just take away the smoothing effect and just show year-over-year growth rates, it actually peaked in 2017. Timing can always be difficult. If you recall the bottom of 2017, you had to go through the 2020 crash still, right? And so, but if I updated for 2024, and this is for if you were to take Exxon, Chevron, BP, Shell, Conoco, Oxy, Hess, Marathon, rest in peace, those two, Devon, EOG, Fang, Pioneer, PR, and Continental, and then take all their acquired companies. So like Chevron's the old Texaco, the Unocal, Gulf Oil, Exxon has both Mobil, BP, the old Standard entities, and take them way, way, way back. They're all in this metric. But 2024 was the slowest well productivity growth rate. And that was before these companies started cutting capex here in 2025 and worries about production growth. But keep in mind, they're cutting capex now, which will hit production with a lag. But it's the slowest rate of growth, 3% outside of a recession. So I think the productivity cycle has peaked, which is, has nothing to do with tariffs. Maybe tariffs just accelerated a little bit, but it comes down to geology. And the thing about this is we're all looking for the Permian to peak, but this is the second derivatives. Like the second derivative rolled over. Now the first derivative's rolled over. So will the Permian peak? Like the numbers are saying so. And in fact, I wonder if I have it in this deck. I hope I do. If we look at just the E&Ps alone on productivity growth rates, this is it right here. So again, this just takes the E&Ps, and I tried to pull out from the integrated guys and the diversifieds, like Conoco has the lower 48. They give us enough data around well count and production to break it out. ExxonMobil and Chevron, U.S. only. Now, if you know their production profiles, there is going to be some offshore within Chevron, but they don't give us Permian only for well counts, and they do for production, but not well counts. These companies don't. But from 2012 through, I would say, again, through about 2017, they were all just parabolic up and to the right. But we've seen some slowing, and you'll actually notice the companies that have slowed the most have basically sold. That light blue line of, can you see an arrow? Does it show an arrow?
I don't think that would only work on screen share, unfortunately.
Oh, that's all good. But that light blue line of Marathon peaked in 2017. They sold, right? And then you had Pioneer, which was, next to Diamondback. They started slow in 2020 and 21. And I believe in 22, they even had, they were moving to cube development, and then some IP initial production rates didn't turn out. So they backed off cube development, whatever. So the point is that they slowed and they sold. Former CEOs there are starting to talk about their slowing effects, right? More blatantly. Continental took itself off the public markets. They slowed in 2019. Continental's going overseas now. They're broken out further
Turkey,
on
right?
the right. What's up?
In Turkey, right? I thought they were
Yeah.
exploring.
Yeah. We'll see how that goes. But even Harold Ham, I broke them out over on the right because they were one of the pioneers in the Bakken of this entire thing. But you are seeing acceleration offsetting that with Exxon and Chevron. I think they're just picking up the pieces where, a lot of the companies they acquired on the smaller E&Ps. But Devon slowed, right? They're the orange lines with the triangles. And so it's not this concerted effort up and to the right that it once was for a decade on productivity. So I think the source rock, according to these numbers and having absolutely zero knowledge relative to a lot of people are going to listen to this of geology, I think it's long in the tooth here.
Interesting. As far as what you kind of expect to see for well productivity and all that here in the US, where does this lead as far as barrels of basically BOE per day? Where does this head over the next several years? You think it's a pretty significant rapid drop off, or you think it kind of tails off? Or because I just look at the different wells, and you see some things, and you're talking about Guyana and wells that are very prolific versus what we have to do to get oil and gas out of the Permian, for example. I just wonder if that's going to lead to rising costs potentially faster than most people are expecting.
Historically speaking, like this chart on slide 14, if these up cycles for development costs, inflation adjusted, right? On average, if you just smooth out big volatility jumps, which can happen due to the way of the oil and gas reserve accounting you're dealing with here. I don't want to get too much into detail. I don't want to lose someone on oil and gas reserve accounting, but typically during these up cycles without inflation factored in, they're rising about 6 to 8% per annum. Okay. And so I think that's also explaining why, the barrel counters will say, let me backtrack. I've been through my fair share of OPEC market share battles, more than I'd ever would think. And this one, at least price action, I don't have charts for this, but anecdotally, this one does not feel like a price war. Okay. I've been through price wars. 2014, 2020, was beginning a career sort of paying attention to this stuff, not as much as now, but 98. Those were price wars. Okay. Those are the lines go down. Okay. And it's just been a slow bleed thus far. So something in essence sort of feels a little different about it. And I think it comes down to this, is that the development costs are rising. The floor for where oil will bottom because of that is rising, right? And that is because in 2014, industry in the Permian was still lowering costs, right? They weren't doing simul-fracs. They weren't getting drill times down to where they were today. And so there was still costs to be taken out of it. And so I don't think we're there anymore. I think the marginal costs, the rate of change is significantly slowed. And I got some good charts on that. I hope I do in this deck that can explain it or give you an avenue into what I'm looking at. But this well productivity growth is not just the Permian here. And these guys' production profile is much bigger than the Permian. And I know that gets the bulk of the focus, and it should. It's been all the growth the last decade. This is across their entire production profile. Okay. And that's what matters in global markets too. So I think we're seeing, can Guyana alone offset what the Permian has become? That's a big question. I don't think so. But on a global looking at it globally, it's slowing. Yeah, you're going to have pockets of growth like here and there. But I think at the broad level, it's all slowing.
Yeah, as far as the kind of efficiency gains topic, there's
Yeah,
been
let's
some
talk about
talk about like how much like they can actually continue to squeeze out as far as efficiency gains, and like you see what's going on with rig counts, and I think
Right.
the drilled uncompleted wells have been falling as well. But what's your kind of view on like how much more the operators can kind of squeeze out of like technology advancements and efficiency and all those things?
I think they're on their last leg, and I started publishing this in spring of this year, and I learned over a long time on the sell side I think that there's more value in understanding incentive structures than there ever will be in guidance numbers. Okay. And what the incentive structures are telling me is that capital budgets and KPIs are getting harder to meet. They're not beating them by as wide of a margin they were just 4 years ago. And they're having to also raise those targets. And they're starting to even here and there miss those targets. Okay. So whereas before, so let me explain what I'm talking about here is that the boards of these companies, right? You have a compensation committee, right? And so they'll say they decide upon what they think shareholders want, right? And they'll try to align compensation targets and incentives around that. So a decade ago, well, I should say more so, beginning like around 2016, shareholders were pushing back and just saying, you got to stop spending so much money, stop focusing on production, focus on how you're spending these dollars, capital efficiency. And then you started to see these companies become very, very capital efficient. And so what you saw is they started introducing capex related and capital efficiency related KPIs within their incentive structures. Make sense? So whereas before someone like a Continental Resources, literally like 60 to 7, I believe, I don't want to misquote, but I believe it is them. If you looked at them in the early days of the shale boom, 70% of annual bonus incentive weightings was just increase reserves and increase production, like drill, baby, drill. Like literally that was it. And then shareholders push back, and then that has industry-wide decreased to less than 3% is resource production growth. But you can see here is that ConocoPhillips up here in the top left, for all these charts here, I wonder if I can zoom in. All these charts here, the bars are the targets that they set for management, and the lines are the actual. Okay. So when the line is below the bars, they are beating their capital budgets or whatever metric they choose. Therefore, they get bigger bonuses, right? And if it's above, then they're missing their targets, and all else being equal, they are getting a smaller bonus, cash annual bonus. Now, these annual bonuses, while they don't make up the majority of compensation for executives, that tends to be more so on restricted stock and performance share units. They matter more for the mid-level, right? The guys in the field. So they matter. The guys who are going to hit these targets. But you can see here for like ConocoPhillips, they were beating, but then in 2020 capital budgets, they had to raise them. Now, yes, they had some projects going on and they made some acquisitions, so I get it. But then they started to miss targets. Now, it's not bad, 4% miss in 2024, only a 1% beat, and then 2% miss in 2022. But it's not just them, and I don't want to pick on just them. It's industry-wide. Diamondback, the lowest cost producer in the non-OPEC world. These charts are small. I apologize for that, but right here, PDF and Ds, this is what we're talking about, is that from I believe that's let's see, 2016, 17, they were able to lower the targets, and actuals came in like double digits below targets, and they were crushing it. But then beginning in 2022, they had to start raising targets, and they're beating by less of a margin. And even on their capital budgets, 2 out of the last 3 years, they've had to raise them. Now they have made some large acquisitions, so naturally capital budgets are going to go up. I get it, but they've started to miss some of those targets. Hess, before it sold, was lowering they had what they called the capital and exploration efficiency KPI within their compensation structure. And for a better part of a decade during this deflationary cycle, it was falling and they were beating. And sometimes they were beating by double digits. But then beginning in 2021, they had to raise them. Okay. And there was even a miss. And so Oxy, after, I think this was Berkshire, they introduced a total spend per barrel. They didn't have it before Berkshire's ownership, but they introduced it. But you can see here, it's been rising. Spend per barrel, another way to say of F&Ds, just a off the cuff way. But they're having to raise the targets. And then same with EOG. Now EOG in the bottom right, EOG is very important because they get the highest multiple because they are the highest returns on capital. They use a different incentive structure there. They target after-tax rate of return on capital spending. But you can see they've had to lower their targets on that. Okay, so it's a rate of return, right? And they're missing it. They missed it for the first time last year. Devon is in the middle, bottom right. They've lowered their targets, and they actually have not been able to beat it for 4 years running. Which, if people are tied into this stuff, earlier this year they introduced this new capital efficiency, yada yada yada, blah blah. They couldn't hit their targets. So this is all telling me that the easy, again, the low hanging fruit has all been cut, and so they're going to have to continue to raise these targets and the standards that existed 3 years ago in order for this industry to get paid. Like it's higher.
Yeah. As far as kind of the capex discussion, capex spend, some of the more interesting charts that you put out is comparing like AI capex to the energy capex, and like you kind of pointed out, hey, a lot of these tech companies have turned into like the exact opposite of what they used to be, where it was capital light and everyone loved them, and now they're spending hundreds of billions of dollars. And I kind of look at the whole thing, and I'm not sure any of them are going to see a real return out of it. But maybe it'd be interesting to get into some of your thoughts there, kind of comparing tech and AI spending to oil and gas, and kind of see where your thoughts are on that.
I had a great post on this. I think it was it 2 weeks ago, Ben? Something like that. And, shouts out. I got to give a shout out to Doug Terrison. He's the one who sort of pointed me, and you know him as well, into understanding the incentive structures more. So he's definitely been a mentor in that light. But if there's something, being an oil and gas guy, I know capital spending, and in 2025 now, this chart over here on the left is Western oil and gas capital spending. And what it does is takes reconstructed integrated oil companies, US E&Ps, Canadians, and US refiners, and stacks them up. And you can see compared versus the companies on the right, the major tech company spending, and you can go through the list. We all know who they are. It's going to vastly outpace this. And since this chart was before the latest earnings seasons and guidance and estimates, I literally every quarter have to add another 50 billion on that axis on the right. It just keeps going up. And what was that one leak out of Meta guy with Trump, who's like 600 billion? Did you see that? It was like on a hot mic. He was like, did 600 billion sound good? Does that sound like a good number we should spend? And it's like the numbers are astronomical. And if you, the incomplete picture is that this chart on the left does not include a lot of NOCs. And in that post, I tried to the best of my ability to layer on the NOCs that disclose data, as well as the Chinese and the South American, and it's still, the tech companies are spending basically more than all of the trackable oil and gas industry. I mean, add them all: Aramco, Kuwait National Petroleum. Unfortunately, we can't get UAE. Add Petrobras, add the Chinese SOEs. Like, add them all. They're spending more on data centers than we are on oil and gas. And why is that? Is that if you actually look at the incentive structures around tech companies, they're vastly different. The metrics that they pay attention to, if there are financial metrics, many of them don't have them. But if there are financial metrics, is things like revenue and operating income. What is that? That's just growth. Okay. What is missing from a lot of these tech companies? Just go scan the annual processes of Apple, Meta, Microsoft, Google, and Amazon. They make no mention of free cash flow. They make no mention of capital spending controls. They make no mention of like even operating margins. Okay. And so if you don't have a governor for growth, like something like return on capital or capex efficiencies, then you're going to chase what you're paid to do, and they're paid to increase revenue. My favorite is one of the metrics that Facebook uses, or Meta, is, quote, build awesome things. It's one of their 4 things. It's literally, quote, build awesome things. How do you measure that? Like, a data center over in Northern Virginia. Awesome. And so I think that understanding the incentive structures. Now, when does this all end? I mean, I began publishing these charts like a year and a half ago, and probably when it was only at 400 billion back then. But it's starting to make the rounds. And this chart, every time I publish it, gets a lot of restacks on other platforms. And I think consensus is wising up to it. The beauty of tech is that it was capital light, so you didn't need incentive structures that regulated capital, because they didn't use any. But now they're using more than the entire oil and gas industry. So you got to start to question that. And on top of that, tech grew because of things like the network effect. And if you ever, I'm drawing a blank on it right now, but a great book, you always ask about books, I'll answer at the end, is Apple in China remained asset light because they got Foxconn to do all the capex and put the working capital on their books, not on Apple's. That's all changing. These are becoming huge capital investment companies, and data centers and, generative AI does not have the same network effects that, back in the day, MySpace or Facebook or Instagram does, right? I just got to tell Ben to be my friend and get on the platform. The growth took care of itself. Now I got to spend capital to grow. And those are 2 vastly different business models that haven't even been proven out yet. Like, I think I was listening to a podcast, and like this guy was saying how he was generating a cover for his report, and it required, in that minute, that generative AI report covered required as much energy usage as powering your refrigerator for a week. So
yeah, I do. Just looking at that chart a little bit more, I do notice that Apple is a relatively small portion, while Amazon, Google, Microsoft are both in. I mean, those 3 are in there for close to, was that 275 billion, if I'm reading that small print right. But it is interesting to see Apple kind of not participating as much. But as far as like how long,
well, I'm going to guesstimate on that, and having, on a scale of 1 to 10, maybe like a 2 or 3 experience in being a tech analyst. Tech and energy bros and broettes are completely opposites, ends of the spectrum. But I think the majority of Apple's capex rests, and capital intensity rests, on its supplier chain, right? So like for example, it's like, like Foxconn, they're the ones who have to build the factories for them, and all of the Chinese suppliers. So Apple doesn't necessarily do it. So maybe I should add them. I don't even know if they have public data. So
Yeah. As far as kind of the different valuations, like obviously the tech companies, a lot of them are at 30 times earnings, 35, whatever it may be. But one of the things that I find interesting is, and this is maybe something that is probably like a 2 hour long discussion in itself, but is the impact of passive investment. Like you look at where the S&P energy sector is, I think it's like 3% weight or somewhere in there, bumping along like on all-time lows. But how do you look at the passive investment and the way the capital cycle plays out and like capital flows? How do you kind of look at that as far as having an impact on valuations of some of the energy companies?
I think energy companies are properly valued
Hmm.
based on current consensus, or even current like current day fundamentals. Okay. Can that change in 5 years? Yes. And so, man, you're talking about the stuff that I'm going to introduce in 2 weeks, but let's see if we got something that alludes to it. I did a lot of work on the summer over valuation, but this is a good look at it. And I am of the belief that here we'll start it. I'll start here, and then I'll go back to. I'm of the belief that every sector in the market, all 11 S&P sectors, are valued over the long run based upon whether or not they can exceed their cost of capital. Now, that can be very hard to measure because if you ever done, a finance 101 class, you have this thing called the CAPM equation and estimating the cost of equity and all these sort of subjective measures. But this is the way I do it. Okay. And over here on the left is just for the integrated oils, but I'm going to have some new charts that just shows the entire oil industry. And it's the same picture, roughly speaking. The blue dotted line is their returns on capital. You can measure this, NOPAT ROCE, NOPAT ROIC. You're going to get the same general lines over the long run, okay? And the orange line is its weighted average cost of capital. And when that blue dotted line is not able to exceed, if you net the two, that blue dotted line minus that orange line on the left, you get this green line on the right, which is shareholder value add, right? Can you exceed your cost of capital? Now you can ask, what are you using for your beta? What are you using for your WACC? I've done it so many different ways, and I got down to the ones that showed the highest correlations in the charts. That's how I decided, because it makes sense. But that purple line on the right is EV to invested capital, which is a modified all balance sheet in company. It's a price to book, right? Right. Hurdle your cost of capital, and you're going to get a higher multiple on the capital, right? Debt plus equity. And you can see here, so when it's above 100%, you're earning over your cost of capital. When it's below, you're earning under your cost of capital. And when it's above 100% for the green line, the right axis of the purple line on the right is above 1 times, you're getting a premium on your capital base. And when it's below 1 times, you're not getting a premium. Makes sense, right? And so we were getting a premium in 21 and 22, but now we're not. Okay. And why is that? It's because we're over the long run, on average, this industry should earn about a 10% return on capital. You hear, major sell side shops say that, but the data even says it over the long run, like, on integrated oils. And this is the same chart for ExxonMobil's, the biggest weighting in that. I believe last I measured 2.6% of the S&P, or about 2.7 of total U.S. equity market cap. This is the same thing you're looking at. ExxonMobil EV to invested capital since 1912, or since the breakup of Standard Oil, and then Chevron over on the right. That's what drives valuations. So my point is that, yes, you're going to have cyclicality to the up and down, but there's also some things that these companies can do self-help wise. And some industries are doing a little bit better than others within the entire oil patch. If you were to look at, let's see, again, getting back into compensation structures, these are performance share units, the average weighting that the integrated oil and gas guys give to their executives. I broke it out in these 10 buckets, but they will weight ESG and emissions, value, which I like this part, or they'll measure profit growth through various metrics, EPS, EBITDA, EBIT, what have you. Some of them will even say capex controls, but you can see beginning in 2016 they started to put more emphasis on it, on value, this thick green line. But my point in what I would like to see more of them do is that beginning around 2020 and COVID and green energy and the whole ESG mania stuff, when energy was bottoming, you can see a lot of them outweighed ESG and emissions targets, primarily the Europeans. They increased the weighting on how executives get paid. And what you had? You had major strategic pivots by some of these European oils, BP, Shell. Didn't work, okay? So what these companies can do, at least on the integrated side, is I literally say in the title of my post, ditch ESG, promote ROCE. Like, and you're seeing that. Like, you have activists taking over at BP. And if you look at their new compensation structures, they're ditching these things. They're measuring things that matter, for free cash flow, returns on capital. So continue to incentivize these executives, and they will make the necessary decisions to not only increase like shareholder value for the equity owners, but also their own incentives. And so I think from what I've seen, I think the companies that are doing it best, broadly speaking, are the integrated oils, as well as the oily E&Ps. And I know everyone's bulled up on gassy E&Ps, but none of them emphasize returns on capital within their compensation structures. And if so, it's very, very minimal. So my point of all this is that, and I know you asked about valuation, but this is what matters. And, if you look at the charts too, like we're trading at, less than EV to invested capital because we're not earning our cost of capital, plain and simple, right? And so if you're looking at this, it's like, okay, how can I earn my cost of capital? Let me incentivize, the members of this team and of this industry to do that. And so if you can't earn your cost of capital, then you have no value proposition in this world relative to other investments. And so what's going to happen if you can't create value is that market participants are going to go to other places, right? And if you're a market participant, if I'm a massive, portfolio manager at a T Rowe, a Fidelity, a Capital Group, like someone that actually like manages real long-term money, I don't have to choose energy. It's only 2.5%. I got this massive swath of investments I could use. And that's what they did. That's what they did beginning in 2013, is that this here uses DeModern data. He updates it every January, and it's lovely. It's phenomenal. I wish he did it more often, but it's a massive data dump. And he breaks it out by the individual industry level. And what I try to do, I aggregate it up to the sector level, the 11 S&P 500 or S&P 500 sectors. And the vertical axis is EV to invested capital. The horizontal axis is shareholder value add. And then you can see that a decade ago, energy was destroying value and still getting a slightish premium multiple according to the regression. I mean, across 11 S&P sectors, his data constantly has this 0.7, 0.74 R squared. It's strong, okay? Is that if I'm looking at this, I'm saying, all right, who's creating a lot of value and is undervalued? One big purple text right there, tech, okay? And yeah, they created a premium, but the shareholder value exceeding their cost of capital by 27.5% is phenomenal, right? And so, but then you fast forward to today in 2024, and that energy right now is massively undervalued, right? It's creating This is as of 2024, not now, right? But at the time, on a rolling basis, it's creating shareholder value add according to Modern's data, not mine, but it's undervalued relative to that. Whereas what's massively overvalued is tech, but the business models of tech are changing, right? But like you say, the flows and the data of, like, capital is going to go where it's treated best. And a decade ago, it was not treated well in energy. It was treated great in tech, and now I think the exact opposite is happening.
Interesting. You did mention natural gas there, so that's maybe a topic we can start to wrap up with. But as far as your view on natural gas, and you mentioned the compensation structures in there, I kind of look at it. I understand like the secular reasons to be bullish when people talk about LNG and all these different things, data center and power demand, but I still can't get all that excited for natural gas. But what's your kind of view on where natural gas is headed over the next several years? Do you think those secular drivers are enough to lead us to a bull market like many people are kind of expecting?
So again, if you're seeing a common theme between the content, and what I try to differentiate is try to understand the cost of supply dynamics, and particularly the incentive structures, and then that ties into the valuation. To repeat myself, what I don't get into is, because I don't think I can differentiate myself, and over the long run, I think it's less of a factor, is counting barrels, counting MCFs, what have you. And what I find within the natural gas land to come down to the conclusion is that I think if prices do respond, well, there's two things going on. The marginal cost of production, from what I see, is not rising. Could that change if you go into the Haynesville? Possibly, yes, because it is a deeper formation, more costly to drill. But what I'm seeing, unlike the oil world, is the marginal cost is not rising. There's just so much of the stuff. And on top of that, the incentive structures are not moving in favor of shareholders as much as other places in the oil world. Maybe that's because the gas E&Ps tend to be a little bit more consolidated, tend to have a lot more CEO founder ownership, right, than the oil E&Ps. But it's primarily those two things. And if I look at gassy E&Ps PD&D costs, or the cost to replace an F&D, we're not really seeing a rise yet. And I'm updating this for production costs as well. And in 2 weeks, we'll have a better model, but it's just sort of just flattened out. We haven't seen this rise. And so until then, you're just going to have this sort of range of gas versus PD&Ds, right? Or its replacement costs, right? It's still cheap to go out and drill and replace reserves. So as long as it's still cheap, they're going to continue to do that. And then you layer on top of that an incentive structure where no gassy E&P out there has any sort of value creation or return on capital metric. And as you can see from those long-term charts, like, that's what drives valuations, right? And so, I can, and I have before, when I was a younger analyst, I could build you demand scenarios up and to the right on any sort of thesis you want. Like, I've done that. But early in my career, I did not understand, these pay metrics as well. And so if management is not aligned to your view, like, it's probably not going to happen. And so that's what gives me a little bit of a pushback to those two things. And so what I show here is that the oily E&Ps are on the left, okay, and the gassy E&Ps are on the right. And in the top left, the top half is just, again, annual bonus incentive weightings. And there's two things. There's resource growth and value creation. What do they value, or what do they pay on? And you can see in the top left, oily E&Ps and especially after Hess has been acquired, they're like 3% is the average weighting on resource growth, and value creation is creeping up. It's going to be 20% with Hess gone. So it matters more. Returns on capital more matter for oily E&Ps. For gassy E&Ps, they're still valuing resource growth more than value creation. Now, they do have capital efficiency targets. That's positive. That's good. But I want to get into like what drives these over the long run. And that's that light blue line. And then when you look into what matters, how these executives really get paid, 40% of their compensation tends to be around performance share units. And for those that don't know what that is, it's let's pick a target, and based upon how that KPI or that target performs, generally over a 3-year period, we're going to give you a payout in shares. So if you crush it, then you're going to get, a 2 times multiple payout. And if you don't crush it, then you're going to get maybe a 50% payout. And so when you look at the oily E&Ps in the bottom left, the popular metric across all of energy is relative total shareholder return, or relative TSR. Does my stock outperform your stock? That's a little bit like putting the cart before the horse. Why not emphasize the thing that drives outperformance? And that's returns on capital, free cash flow, EPS growth. So when you look at that, oily E&Ps have a higher weighting within that big slice of incentive pie towards returns on capital. Again, that's going to grow higher, I believe, in 2025, in this year. And gassy E&Ps have absolutely zero towards ROCE, cash ROCE, ROIC, ROE, ROA, any of that stuff. I mean, it is based upon primarily actually on 2 things, I believe: relative TSR. So can I make my stock go up more? Can Range outperform, I want to say Chesapeake, but expand? Like, that's literally it. But why not focus on the thing that makes you outperform it? And so at the end of the day, I just don't see, I see more of an environment where these guys can continue to add, cheaper gas. I haven't seen an inflationary environment or a rising cost environment like I have in the oil, where the data is not telling me that. And I don't see the incentive structure where it's fully aligned.
Yeah, it is interesting because it sort of has become, even for energy specialists, like there are a lot of people that are very vocally bullish on natural gas, and I've done some digging, and I still look at some of these companies, and just, I don't know, I just haven't found anything that really looks all that compelling. But anyway, is there anything, as we start to wrap up here, is there anything we kind of skipped over that you want to slide in here in the last couple minutes?
I think last time we talked, the macro was pretty darn bearish on refining. I loved it. I continue to love it. I think that there maybe I'm just trying to get cute with it. Someone that gathers 100 years worth of data, you shouldn't listen to them for the quarterly stuff. It's like, never trust a skinny cook. But I'm just trying to get a little cute with it. I guess refining stocks have done a lot better. I think the demand is weakening because of the macro factors that are now consensus. But I think refining could be an awesome story. Companies like the rest of these industries are literally replicating the models the refiners implemented a decade ago, which was stop growing, buy back your shares, pay your shareholders. That's it. Like all cash. Like we are at best, global oil macro grows, 1% decent, okay environment, 3%, awesome environment. Typically when you're coming out of a recession, that's what you got. So, watch your capital spend. And if you look at what's for various reasons, the capacity additions out through 2030, I don't think are going to offset net deletions. So we could have refinery shortages definitely by 2026. Now it depends on the agency you listen to. Some have refineries occurring in 26, some have it in 25. But you get to this point where in 2028, we've had basically for the last decade deletions off, or retirements have average 800,000 barrels per day along this right chart, 0.8. And then additions in the projects that have been announced out there, and it's the usual culprits, China and India. Their capacity adds aren't going to keep up with that. And so unless we transition to EVs pretty darn quick here, we're still going to need oil. And you don't need 1.5 million barrels a day. You don't need the environment of China in the 2000s. You just need growth, because capacity is not going to keep up with growth, and that's going to tighten margins. Right now, you have a good feedstock spread between the heavy, light, sour, sweet with that's occurring. So I think that's positive, and that matters for the global macro, because you cannot have strong oil prices without strong refining margins, because they're the real users of oil.
Yeah, it is interesting to see. I've heard a couple people kind of point out the refiners over the last several months, and they kind of agreed with your take that things start to look pretty good for them, either later this year or 2026, sometime in there. But it will be interesting to see, because excuse me, there's a lot of focus on the upstream, and some people looking for income to go to midstream, but the refining seems to be like the redheaded stepchild, almost like by default, for the whole energy sector.
Yeah, I mean, if I always try to give someone a framework, and if you, depending on where you think we are in the cycle, or let's just say the business cycle, right? I have been in the camp for like a year now, and it's starting to become consensus. It literally is consensus now, but that we were in the midst of a slowdown. Entering this year, I think the labor market, this is just broadly speaking, right? The labor market was soft. The April actions only made it softer. And what we're seeing now in all of these job numbers is just making that viewpoint consensus. Okay. So now the question becomes, I guess you could say, is this just a soft patch, or, is this a recession? Unfortunately, we don't have enough data to know right now. The markets are certainly not saying that as of right now. Whether it be, I guess, certain parts of the market, you are seeing a lot of softness in the cyclical sectors. So that would be things like manufacturing, and construction is rolling over. You don't, like, when construction rolls over like this, you almost always have a recession. Look, I put a chart out on my Twitter or X, like specialty contractors are rolling over hard. Residential construction employment's rolling over hard. Non-resi looks peakish. And if you look at some of the Census Bureau data on construction, it's rolling over. So resi, with the employment numbers. My point is that if we are like at the early stages of a downturn, it is a tough time to own energy. But the best times to own it are in the bottoming phase and then the early cycle recovery. And what you tend to find right now is, and what I tried to highlight here in this table, is that during the downturn, and let's say we're in it, like, I don't know, we won't know after the fact, but during the downturn, relative to the other groups of refining and oil field services, you want to be in integrateds and E&Ps. Like, oddly enough, E&Ps. If I had to say, I'd probably say integrateds, right? Bit stronger balance sheets, strong dividends. Like the E&Ps too, like everyone's cutting in advance, right? Before you would see them cutting after the fact. But then when you get in the bottoming, and if you just think of like, a cycle chart with your arrows, the bottoming is like the bottom half, like just when it's the rate of change starts to improve. Okay. And then the early cycles when it turns up. E&Ps and refiners are your best bet. Like, they historically, over NBER defined recession, for the stock data that I have monthly, they perform the best. E&Ps and refiners is where you want to be. And they're sort of like, where you want to roll with through about mid-cycle. And then mid-cycle to late cycle is when oil field services tends to improve. How would that align with the view that I have is that I still think oil field services is a back half 2020 story. There needs to be a little bit more consolidation, in my opinion, among them, like with what we've seen in the E&Ps and the refiners. And so, but back half and late cycle tends to be the oil field service names. So it's a good way to think about it if you're in that slowdown recession camp. If not, if you think this is more of like a mid-cycle pause, then refining is still a good place, and then possibly oil field services. So I'm going to lead a little bit more towards the big R word. So
yeah, it is interesting to kind of get into the rabbit hole on some of the statistical data and jobs and construction, all this stuff. I think it is.
yeah.
It's definitely not an economic boom that we're going through right now. I think that's at least safe to say. So,
Yeah.
Before I let you go, I do have to ask my traditional closing question, which is, what book should I add to my reading list? I know you mentioned Apple and China earlier, but I figured I would steal another one from you.
Let's see. I'm actually I tend to do, and I'm just looking at audiobooks right now. Apple and China was probably one of the best ones I've read as of late. I actually liked, for the golfers out there, it was a easy summer while driving, 8 hours, 10 hours in the car up to New Hampshire. Together We Roared, Steve Williams, Tiger's caddy.
Okay.
Very easy listen. But if you want to get me, probably like my favorite macro book of all time, or one of them, I put it like top 2, if that, and just a fascinating story. He won Pulitzer Prize, I believe, on it. Lords of Finance. It's a couple years old. I can't pronounce his name. I'm looking in my audio
Yeah, I
book.
think I've gotten that one once or twice, so maybe I'll have to bump that up the list. So
Absolutely love that one. That one was great. And I would also, I think we didn't really talk about it, but I read this soon after COVID. Nick Timmerose, $1 Trillion Triage. I love the beginning part of that book. It gives a history of the Fed and its history with gaining and losing independence, which aligns, and we've talked about, we didn't get to the charts today, it aligns with commodity cycles. And that's front and center right now. And so I think it's very interesting.
yeah. So as far as any listeners might be looking to check out your work or find you on social media, where can they look you up?
Yeah, so if you just you can Google it or find me, the Crude Chronicles. My main platform is, I publish on Substack. There is a free version. It will be paywalled, but not every Monday, most Mondays, I give a little snippet of something that was below the paywall a couple weeks ago. Just don't like to give away too much for all my paying subscribers. But the content you'll find there, I always like to tell everyone, like, I don't give stock recommendations. Particularly, I will give you general overriding thoughts to work into your own framework. But my shtick is the history and talking about the cycles. And I've added on lately the incentive structures, because that determines the cycles as well. You can find me on X. I do a little on LinkedIn. I got to get better on that though. But I feel like everything on LinkedIn is like a hire me.
Yeah, it's I deleted mine a while back. I don't regret it at all. So
I've met some great people that reached out through LinkedIn, some very influential investors.
Okay.
And
Well,
so
maybe I'll reconsider.
I refuse to shut it down. So
yeah, but I appreciate you coming on. I definitely think we'll have to get you back for another round whenever that new deck comes out. That'll be a good excuse to maybe get into it some more and kind of see what you're seeing as far as that whole set of charts, because I think the visuals of all the data you provide are very valuable. So, but yeah, definitely think it was an interesting conversation. I got a lot out of it, but I think the listeners will as well. So, I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.